I will cover the first few slides to just quickly introduce export finance and multilaterals. And then my colleague, Mr. Kitada, will continue to discuss the different programs that ECAs and multilaterals are able to offer. My colleague Zia had presented earlier on project finance, and one of the slides that he used was this slide, where he talked about multilaterals, ECAs, development financial institutions. So our presentation today, Kitada-san and mine, will handle this part of Zia's presentation, particularly with regard to how ECAs, multilaterals are able to help in funding projects. Okay. ECAs or export credit agencies are mainly institutions which are, or agencies which are government-owned. So the reason for being there is really in support of exports coming from their countries. So mainly to promote trade between their country and other countries. You'll see some in the screen, some names of some of the ECAs coming from the major developed countries. You'll notice that some of the countries in the screen have more than one export credit agency. So some of them have two. So for example, China and Japan have two export credit agencies each. And the main difference between the two export credit agencies is that one provides funding and the other one provides mainly guarantees or insurance. And I'll go to that very quickly. Export credit agencies have a multitude of many products that they offer, ranging from providing short-term financing support or guarantees to long-term guarantees or funding support for large infrastructure projects. The main programs or products that the export credit agencies use can be divided into direct loans, guarantees, and insurance. So direct loans, for example, for the Japanese export credit agencies, JBIC provides direct loans to programs or to projects. For guarantees and insurances, I mentioned that the Japanese have another ECA called NEXI, or Nippon Export Insurance, and they provide guarantees or insurance programs. Then the reason for guarantees and insurance programs being there is that many banks sometimes don't have country limits for certain countries that they would like to support. So for example, a company like Marubeni may be exporting into Mongolia, but maybe Sumitomo doesn't have the very long tenor country limits for Mongolia that are needed, say, for TTPI or for Oyo Tolgoi. And therefore, that's where NEXI or the other export insurance or ECAs come in, because they provide guarantees and insurance to banks like ourselves so that we can lend to projects on 15-year or even longer kind of tenor. The last thing I wanted to say on export credit agencies is that you notice from the screen, and this is not a complete list, there were many export credit agencies. And it's very easy for the different export credit agencies from each country to compete among themselves, undercut pricing and the like. So several years ago, when the OECD, or Organization for Economic Cooperation and Development, was first established, they realized that there was a need to regulate or come up with a set of guidelines or rules that govern export credit agencies. So that the underlying terms among the different ECAs are more or less similar. There are a little bit of differences between the different ECA programs or different ECAs, but the general rules are the same. And my colleague, Mr. Quedada, will talk a little bit more about that. So they established the OECD consensus rules to make sure that the ground rules are the same among most of the OECD export credit agencies. So I'll move on to talking about multilaterals and development financial institutions. So multilaterals are essentially institutions or entities which are supported by various countries. So they have many different member countries. And the funding or the capital for each of the MLAs or the DFIs are provided by these countries. Now, you'll see again from the screen that there are different kinds of multilaterals and DFIs. So you have from the international multilateral agencies like the World Bank or EIB or aid, for example, which cover the whole of the world in different regions around the world. And then you go down to regional development financial institutions or multilaterals like the ADB or the Islamic Development Bank, which covers specific regions. So ADB, of course, covers the Asian region. The African Development Bank covers Africa, and so forth and so on. And then you've got national country-specific development financial institutions which cater to the development objectives of their specific countries. So, for example, you've got FMO from the Netherlands, or you've got KfW from Germany, who mainly operate from the development objectives of their countries. So FMO, for example, while they're willing to support projects which have a European, more widely European angle, they're essentially owned by the government of Netherlands. So they'll take their direction from what the government of Netherlands wants to do with the funds. MLAs or multilaterals and DFIs, similar to ECAs, have a number of programs, but mainly they provide direct funding or direct loans from and advisory from their capital. But for certain multilaterals, they also provide guarantees. So, for example, the World Bank, the IFC, or MEGA, which is part of the World Bank, provides guarantees or insurance programs. My apologies for this slide because it's obviously very difficult to see, but not to worry because the organizers will share copies of the presentations that you see today with you at a later after today. So I think you can just send them an email and they will send you a copy of the presentations. But what this slide essentially shows is that if you look at these two tables, you'll see that the top names in the tables are essentially Asian export credit agencies. So it's either from China, Japan, or Korea. And that mainly shows that their exposure in the region, or the Asia-Pacific region, is the largest among the different ECAs. So they're the largest supporters of projects in the region. And the only thing I wanted to say there is that this is the same thing that SMBC sees in our projects, and there are a couple of reasons for this. The first reason is that the Asian exporters are probably the more competitive ones, able to price more cheaply, and the quality is at par with Europe or the US. So quite often when it comes to bidding for power projects, ports, airports and the like, we often see that the Asian exporters are the ones that win the bidding. So in support of those contracts, the Asian ECAs are there to help support the financing. The other thing also is that we see them more often together with sponsors, Asian sponsors going into the different countries. and the exporters follow suit. So that's also one of the reasons why you see them there. So this is just not related to exports directly, but also to a certain extent, untied facilities, which are not directly related to exports, but ECAs also provide funding. And my colleague Kitada-san will touch on untied financing very shortly. And then my last slide before I hand it off to my colleague Kitada-san is just to summarize a few of the reasons why, or the benefits that export credit agencies and multilaterals are able to provide to projects or to borrowings from corporates. And one of the obvious reasons is amount or size of amount that can be raised. Quite often, especially for mega projects that was discussed earlier, the amount of debt that needs to be raised is quite huge. And I mentioned also earlier that quite often, if you're looking at offshore banks, many offshore banks don't have the size of the limits and the tenor of the country limits to be able to fully support all of those projects. That's the reason why you have, or you need export credit agencies and multilaterals to be able to provide guarantees, insurance support for banks like ourselves to be able to lend larger amounts and to be able to go longer tenor. In addition to funding that comes from the banks, we've seen also in many projects around the globe and around the region where multilaterals and ECAs also provide direct loans, like I mentioned earlier, and that you're able to expand the size of the funding sources and the funding amounts that you're able to raise for projects. So, for example, a couple of years ago, SMBC had worked on the largest financing in Australia, or largest financing globally, and the project was in Australia, where the total debt size was $20 billion. And the tenors were over 15 years. So if you just go to the bank market to look for funding for that size, it's impossible. You're never ever going to be able to find that kind of source. So that's where ECAs had come in. A large part of the funding for that project came from ECAs as direct loans, but a large part of it as well came in the form of guarantees and insurance from the ECAs, but funded by banks like SMBC. So I touched on tenors. So for ECAs, ECAs are able to go long tenors, and the general policy is if for project finance transactions, ECAs are able to go for whatever the tenor of the construction. So if your construction is 3 years, plus an additional 14 years of financing. So 3 plus 14 plus is 17 years door to door in terms of financing, for example, for corporates. And then finally, I mentioned ECAs provide direct loans as well. So that allows funding diversification. So the funding just doesn't come from commercial banks, but it also comes from ECAs or multilaterals. And you're able to expand the amount that you're able to raise. So I'll now call Mr. Kitada to present the different programs of the different ECAs and multilaterals.